You are welcome to our today's lesson. Today we are going to discuss about prepayments and accruals. Okay. Today we are going to discuss about prepayments accruals. So two aspects. There are another aspect also, depreciation. Depreciation also important to be discussed, and events after the balance sheet also we will be discussing in later lessons. We will be discussing today. I am going to cover you the areas of prepayments and accruals. First of all, we will see what is the prepayment, okay, and what is the definition, and thereafter we will discuss one example for each. So you will get a good clear idea about what is prepayments, in what is accruals, and how it will be treated in profit and loss account, and how it will be treated on balance sheet, and how it will appear in T accounts. So let's start with prepayments. What is the prepayment? Prepayment is a payment made in advance for an expense. Prepayment is an payment made in advance for an expenses. Okay. Uh, for an example, telephone. You may pay the different amount. If you didn't receive the invoice or bill for the telephone charges, you would have paid a flat amount. So that may be increased one or decreased one. Okay. Overpayment or underpayment. So if it is the under overpayment, then there's a term rise on that prepayments. Okay. So what is the double entry we will pass for the prepayments? Prepayments in the sense cash is going out, right, for an expenses. If the cash is going out, for that we would have made an payment earlier itself. Okay, that means cash account credit and particular expenses account is debited. Expenses, increase in expenses always debited, and decrease in the cash and decrease in the assets will be credited. So cash account credited, particular expenses account debited. Okay, at that time when the transaction taking place, we used to pass that entry. These prepayment and accrual expenses, we used to adjust this, pass these entries at the end of the financial year, or at the end of the accounting period only. Okay. Or if you are preparing the final accounts uh, once a year in such a period, at the end of that period we used to prepare the prepayments and accruals. We used to pass the entries for the prepayments and accruals. If we are preparing the financial statements, final accounts, every half a year in the sense also we used to do that. Normally at the end of the year, normally all the entities have to prepare the financial statements, because as per the requirement of the law. So prepayments and accrued payments you won't come across very often during the practical bookkeeping. Okay, so a payment made in advance for an expense. Okay, it's a payment, prepayments, prepayments in the sense a payment made in advance for an expense. That is double entry is prepayment account. So we have to remove that. Now what we used to say is, for an example, if we have made a payment in advance for the telephone, in the sense it is already in the expenses account. Understood? So we have to remove that from the expenses account and debit it to prepayments account. We are creating a prepayment account, that is the asset account, current assets account. It is coming under the current assets, and it is an asset. It prepayments are increasing, then assets is increasing, then prepayment account debited and expenses account will be credited because there is a decrease in the expense, so it is credited. Okay, for this, if I provide an example for why prepayment account is debited and why expenses account is credited, I'll show you how. Why, if you say we have paid, I will open 240 accounts. From that you can understand why, because here you will say debit and credit. Here you will say debit and credit. Okay, here we in the normally, if you say you have paid 20,000 for the electricity bill. Okay, since what is the double entry, you will pass cash account, cash account and electricity account. Cash account always credited, because when you are paying the payment 20,000 credit, and electricity expenses is 20,000, right? So okay, here in the example we are discussing, so I don't need to separately open this account. We will see that example. From the example you can understand. Okay, right, that is, we will see the example. Through example I will explain to you. Mr. Kent started business on 1st of January 2023, right? He is starting the business on 1st of December, 1st of 1st December, sorry, 1st of January 2023. He is starting the business. Okay, 1st January 2023, and during the year to 31st December 23, right? So he is closing his accounts 31st 12 2023. Okay, 12 months period. Each and every accounting period, financial period, should be should consist 12 months. Okay, so prepayments for insurance. Then he made the following payments for the insurance. He made the following payments for the insurance. For a very good example is insurance, right? So Mr. Kent started business 1st of January 2023 during the year to 31st December 2023, right? He made the following payments for the insurance, right? On 10th January 2023, right? 10th January. This is his accounting period, okay? This is his accounting period. On 10th January 2023, 80,000 for the first 6 months, right? On 10th January 2023, 80,000 he had paid for first 6 months, that is to 31st June 2023. So shall we pass the entries, right? Here there are two accounts involved. One is cash book. Cash book. Debit. Open the T accounts as, right? Say cash. Okay. Second one is insurance account. Insurance. Insurance debit. Right? Insurance. Cash account and insurance account is going to involve. Now we say 10th of January he is paying 80,000 for the first 6 months. 10th of January 2023. He is paying insurance. How much? 80,000. Right? So insurance accounts we are going to debit it on 10th January 23, cash 80,000. 80,000 was paid. So for that adjustment we have made the adjustment for that. Second transaction is 15th June 2023. He made 160,000 for the next 12 months, right? Next 12 months means this is for this payment made for January to 1st January to 23 to 31st 30th June 23. This payment is made. Now he says he made the payment. We will pass the entry on 30th June, or sorry, 1st June, 1st June 2023. Insurance 160,000 was paid, and here we'll say 1st June 23, cash 80,000, 160,000. Okay, wait, see. 160,000. Okay. So cash account credited, insurance account debited because cash is going out. So we are debiting the crediting the cash, and insurance is the expense account. We are debiting the expense account. 160,000. So read the transaction very carefully. Sorry. First June 2023. 15th June. This is 15th June. Okay. I will make it as a 1st June. Otherwise, I had to adjust it there. 1st June. Right. 1st June 2023. He is paying 160,000 for the next 12 months. Next 12 months to 30th June 2024. He's paying this one for 12 months. This is for 6 months. 6 months. This is for 12 months up to June, from 1st July 23 to 30th June. 30th June 23. That means 12 months. 12 months. Accounting periods is in cutoff periods. It is 31st December. Okay, here excess 6 months is involved. Here in this 160,000, payment made in excess for 6 months is involved, right? So we have to calculate what is the overpayment. We have made an overpayment, okay, for next 6 months. Next year, next it is falling to the next financial year because it is 2024 up to 30th 6 2024 it was made. So we have to calculate if it is 160,000 for 12 months, how much is for 6 months? It is 80,000. 80,000. Here we have, earlier also we have paid 80,000. So 80,000 of insurance expenses overstated in this T account. So we should not overstate the or understate the income accounts or any accounts, and we have to make it on accrued basis. So we have to remove that 6 months insurance from this account and transfer it to prepayments account. We are going to start a prepayment account. Here we are going to say prepayment account. Prepayment account. Debit and credit. Prepayments. Because prepayments is says prepayment made in advance. Payment made in advance for an expense. This is expense. We have made a prepayment. Not an expense for any account. Okay. It may be for right. For asset purchases also we would have made an advance payment. Okay. So that is coming under the no, we will say advance, payment made in advance, we will say, right? So here we had to remove 80,000 overstated amount. So but how we can remove from this insurance? We have to credit it. So if we want to decrease the expenses, it should be credited, right? So 80,000 creditor. This is we are passing this entry 31st 12th 23. Prepayments. Prepayment account. Okay. 80,000. Then prepayment account going to debitor. Means insurance. Insurance. 80,000. 80,000. So now we have to balance it. Requirement. No. First, show the extracts from the statement of profit and loss account and statement of the financial statement. Written up T account for insurance, that is B, and C is loss of the close the T account. We are now closing the T account. Balance. Brought forward. Brought forward 240,000. Okay. Here we have to balance it 240,000 and 240,000. 160 balancing figure. Balance carried down 160,000 balance brought forward here 2000 balance carried down 80,000 balance brought forward 80,000. Right, now we have balanced the T accounts. Now we show extract from the statement of profit or loss and statement of financial statement. Show the extract of profit and loss. Here I will say profit and loss extract, debit, credit, profit and loss. Okay, in profit and loss account, here revenue, here admin expenses, administration expense. Okay, and balance sheet. Here non-current assets, assets, current assets. Okay, here non-current liability, Here is current liability. Okay, so take the balances. First is cash balance is the credit balance. We have to take it here. Current liability. Cash. 240,000. Right. 240,000 because it is the credit balance. Insurance is debit balance. It is an expenses. So we are showing under the in admin expenses. 160,000. And insurance prepayment 80,000. This is the profit and loss account. This is a balance sheet. In profit and loss account, we are showing it insurance expenses under the administration expenses and cash account in the current liabilities. Normally it comes under the current assets, but here it shows a credit balance. Because of that, we are showing at the current liability, and insurance prepayments showing under the current assets because it is an assets. So I hope you would understand the prepayments. So welcome. So we next we can move to the current accrued expenses. Accrued expenses is known as a payment not made for any expenses for an expense that that is incurred during the accounting period. a payment not made for an expense that is not that is incurred during the accounting period. Any expenses which have not been paid during the year which are relevant to that particular period is called as accrued expenses. I mean, telephone expenses belongs to the current period not paid. Telephone expenses, electricity expenses not paid for the particular period for which we are doing accounting for that. So that is known as accrued expenses. So normally expenses are credited, debited. Okay. Here accrued expenses, we have to pay the expenses, so we are debiting the double entries, debiting the expenses account, and crediting the accrued expenses. We are opening the accrued expenses account, which is the liability for us. So accrued expenses credited, liability is increasing, therefore it is credited. This is the double entry for accrued expenses. If we take the examples, you can understand. Amit stated started sorry Amit started business on 1st April 2023, and during the year to 31st March 2024. He is starting first 1st April 23 to 31st March 24. This is his accounting period, right? 12 months period. 1st April 2023 to 31st March 2024. Okay, that is the accounting period for him. He made the following payments in respect of telephone. In respect of telephone. 18th July 2023, 5,000 for the 3 months to 30th June 2023. So we had to open first of all cash book, cash, debit and credit. Next one is accrued expenses. Debit, debit and credit. Accrued expense. Okay. And third is telephone charges. Expense. Telephone expense. Three accounts we have opened. Here also we have opened three accounts. First, 18 July 2023, 5,000 for the 3 months to 30th June. So cash is paid 18th July. 18th July. Okay, paid for telephone 5,000. 000. Okay. 5,000. Paid for 5,000, which is telephone charges. In telephone charges, 18th July, cash 5,000. I paid. Okay. And next on 22nd October 2023, 6,000 for the 3 months to September 2023. So 22nd October, paid telephone charges how much? 6,000. 22nd, 10th, cash 6,000. Okay. Here, um, October 22nd, they are paying the telephone charges for next 3 months, 6,000 and 6,000 up to September, right? For the month ending up to September, 6,000. On 14th of January, 14th of January 24, they are paying the telephone charges again. Okay, 7,500. 7,500. 14th July, January, cash 7,500. Okay. 14th January 2024, 7,500 for the month of for the 3 months to December, 30th December, September, October, November, December. October, November, September, October, November, December. For those 3 months, he had paid on January. And another information is given as at 31st March, Amit estimates the telephone charges to 9,500 was owing, did not receive any bills from the operator. As at 31st March, Amit estimates 9,500 was owing for the 3 months ending 31st March 2024, but he did not receive the bill from the operator. Okay, he didn't receive any bill. He didn't receive any bill. In absence of the bill, you had to make a provision. Provision means you used to estimate the expenses. You may have the average expenses for that particular this thing. So you estimate it. He also estimates, and he estimates that 9,500 for the last 3 months. Okay. So now the based on his estimates, we had to pass the entry. He says telephone expenses 9,500, right? On 31st March 2024. Accrued expenses, accrued expense. Okay, this is accrued expenses. In the accrued expenses, we are crediting. Accrued. 9,500. Okay, we are crediting the accrued expense. Why we are crediting the accrued expenses? Because it is payable for us, payable by us, right? Why telephone charges we are debiting the estimated amount? Because that has to be paid. That expenses for last 3 months has to be paid. So that's what we are debiting the telephone charges. Now we have to balance it. Okay, 18,500 cash. 18,500 balance carried down. 18,500 balance brought forward. 18,500. Right here, accrued expenses 9,500. Here 9,500 balance carried down. 9,500 balance brought forward. 9,500. Okay, so here is the total 100, 1, 10, 17, 17, 20, 28,000. 28,000. 28,000. Okay, 28,000. Then balance carried on 28,000. Balance brought forward 28,000. So B part is over. B part of the account is over. Now we have to prepare the balance sheet and profit and loss account. Wait. Okay. So we have to prepare the balance sheet and profit and loss account. Here I will prepare the balance sheet. Here non-current liabilities, non-current liability, non-current asset, current asset, non-current liability, liability, current liability. Okay. So profit and loss account, I will show you. Done. Debit, credit, profit and loss. Right? Here revenue, yeah, under the admin expense, administration, administration expense. Okay, yes, revenue, profit and loss. Right here, cash is credit balance, so we are showing under the current liabilities. One is cash because it had a credit balance 18,500, and second one is accrued expenses, also credit balance 9,500. 9,500 accrued expense. Okay, and telephone expenses and the administration expenses. Telephone 28,000. Okay, so how things are okay. Finished. This, this is the current assets. This is the financial statement. Okay, this is balance sheet. This is profit and loss account. Okay, understood? I think you would have understood because here it is cash account. Cash account had a credit balance. Because it had a credit balance, we are showing under the current balance, current liabilities. Normally cash account is shown under the current assets, right? So here we are showing the cash account under the current liabilities because cash had a credit balance. Other thing is accrued expenses. Accrued expenses also having a credit balance. So we are showing the accrued expenses under the current liabilities. So it is accrued expenses 9,500. Then the telephone charges. Telephone charges is the debit balance. Always telephone charges will be debit balances. So in profit and loss account, we are showing under the administration expenses, that is telephone charge expenses 28,000. So both we have covered the prepayments and accrued expenses. So now you would have had a good idea about both adjustments. These both adjustments will take place at the time of we are preparing the financial statements only, right? Every month we are not passing, because if we are preparing the final accounts every month, then of course we have to pass these accrued prepayments and accrued expenses every month. Okay, so I hope you would have understood, and we will meet in next session. Maybe I will teach you depreciation, about depreciation and events after the balance sheet. Okay, thank you for joining, and I hope to meet you in next session.